Hey, I'm Nick Rosado with Kim Rosado LLP. I'm here with my partner, Tony Kim. Today, we're going to talk about professional employer organizations, which are companies that handle the HR function for businesses. You might hire them thinking that they're going to take a lot of issues off your plate, but we're here to talk about maybe some tax issues that might be generated by these PEO organizations. So, Tony, maybe just give us a little more background on what a professional employer organization or PEO actually does.
Sure. A company, particularly a small to medium-sized company, may say the HR functions, such as collecting and remitting employment taxes, such as FICA, and filing the forms with federal and state authorities. They just don't want to do all that. So what they will do is they will hire an outsourced company, such as a PEO, and say, okay, we'll pay you a certain amount per month or annually. You handle this function for us so we can do the business that we're good at. We don't want to do this back office stuff. So that's what a PEO does. And you think, okay, well, they get a certain fee, they do their work. What's a potential tax issue that can come up? Well, a potential tax issue that came up for one of our clients who came in was where the client said, well, I've got employees at a restaurant chain, and I think I'm due an employee retention credit, which was enacted by Congress to help companies who suffered during the COVID period. And so these employees who work for these restaurants were made employed, and the employer said, well, I think I'm due employee retention credit. When they contacted their PEO, the PEO said, no, we earn the employee retention credit. You, the employer, do not. And that was the confusion. Under tax rules, who gets the employee retention credit? The PEO, who's the outsourced company, or the company itself, who actually hires, retains, and employs these workers? The answer is, under the tax code, it seems that there is, in fact, a co-employer model. So when a PEO files, let's say, a form, a 941, a form 941 or 941X, the PEO is using their EIN, their employer identification number. So if the employer who has a separate EIN tries to file a 941X, an amended 941X, saying, I want the employee retention credit, the IRS will not recognize them because the original 941 was never filed with that EIN. And so the result is, when this mismatch or this conflict happens with a higher PEO and a taxpayer, the only resolution, unfortunately, is not through the IRS. The employer who hired the PEO has to sue the PEO to try to litigate this matter out.
So maybe to go back and maybe flesh that out a bit. So because the PEO filed the original employment tax return, they paid the tax technically to the IRS. The IRS says, well, for us to issue a refund based on those taxes, the same taxpayer who filed it, which is the PEO, has to go back and claim it, right?
That's right.
So, you know, the employer who hired the PEO is in a tough bind, in a bind, because they have to go in and say, well, we can't file the amended return. PEO, we need you to do it and get this money that's due to us because we actually paid the taxes, right?
That's right.
And
So go ahead.
yeah, I mean, just how does what's an employer that's maybe dealing with a difficult PEO supposed to do in this situation?
Yeah, unfortunately, the only resolution is you contact them, the PEO, and try to reach a resolution which is fair. And if the PEO is difficult, the only remedy is litigation. That's it, because the IRS will not step in because of this co-employer model. The IRS will say, well, you structured the agreement. You have an engagement with a PEO. That's a civil, that's a private matter. And they will wash their hands of it and say, we're not going to step in. So ultimately, it's up to the employer, the one who may be engaging a PEO, to be thoughtful and protective before they hire them, which is, there seems to be two options. One is in the engagement, in the agreement with the PEO, ensure that the terms provide that if there are any credits that would flow to the employer, that the PEO must remit that to the employer. And if they don't, within a very timely manner, they're going to be subject to a severe penalty. So you've got to have your in-house attorney or outside attorney make sure that the terms of the agreement between the PEO and the employer, they provide for protection. The second option is instead
So
of,
I guess, Tony, on the first option, you just have to paper things. You have to have the contracts in order so that you're protected if you have to sue, right? That's it. Ultimately, if they're giving you trouble and you have to sue them, you want to have some good grounds to recover in that situation. But that does require litigation, right? So is there any way to maybe structure this so that hopefully you can avoid litigation in a situation like this?
yeah, the only way to head off the potential or the risk of litigation is you've got to get that agreement airtight. So you get an attorney, you look over a basic agreement that a PEO will provide to you, and we've looked at a few of those basic agreements. They do not protect the employer. So you've got to make sure it's modified so that if the PEO is supposed to turn over credits that you are due as the employer, that they are subject to litigation fees to pay back to the employer. There's if they don't return credits within a timely manner, let's say within 2 weeks, that they're subject to a severe penalty as well as litigation fees. So you've got to make sure that you get that basic agreement and supercharge that with an attorney.
And maybe the most important thing is maybe to be selective, right? And there are certified professional employer organizations that maybe are safer to deal with. Is that?
Yes, there are. So if you go on the web, the IRS has a site of certified PEOs. And what certified PEOs have to do is they have a bonding requirement. They have an annual financial check. There are all these requirements to get certified. But two things with respect to these certified PEOs. One, when you look at the list, you'll notice that there aren't a lot of them. The advanced cost of becoming certified is quite hefty. So that limits the population of certified PEOs. Also, if you look for a certified PEO, what I've heard is they upcharge. That is the difference between a PEO and a certified PEO. A certified PEO may cost you 30–40% more than a PEO. So some companies will say, no, we'll take a pass on the certified PEO. And so what they will do is they'll go to a PEO and hopefully they get connected with a reputable, decent PEO that will charge less than a certified PEO. So the lesson there is you've got to do your homework. If you're not going to pay for a certified PEO, find a PEO that is a referral. Someone refers a PEO and say they're great, but even if they come with a great reputation, you've got to make sure that the agreement covers you so that you don't have a risk of litigation.
And say even we get through all this, you have a good PEO, they actually go and claim any refunds that you're entitled to. The IRS issues a refund, say for the employee retention credit or for anything else, any other employment tax refund. But what happens in the strange situation where that PEO has a tax liability? Now the IRS is issuing a refund that's supposed to be meant for your business, but your PEO has an employment tax or a tax liability that the IRS wants to collect against. What can they do with your refund?
Yeah, the PEO, strangely to us, but the PEO can take their client's tax credit, such as the employment tax credit. The PEO can take their client's credit and apply it to reduce the PEO's own tax liability.
Or the PEO doesn't really, the IRS will take it, right? The IRS will automatically just offset any credit that's coming in for the PEO against the PEO's tax liability, right?
Yeah, and that's the strange part. When Nick and we both looked at it, we found that strange and yet logical at the same time, because the IRS does not want to collect. It does not want to be forced to collect. So that's why we have a pay-as-you-go model. Employers have to remit employment taxes. If employers don't, the employer is liable. Here, the IRS says we don't want to have to go after and collect. So what they will do is they will take the credit that's due an employer and just simply say, okay, we're going to take it, even though we're taking it for purposes of reducing or extinguishing a liability of another taxpayer, which is a PEO. So how do we know that? There was guidance. Nick, was that a field service advice or chief counsel advice? Where chief counsel advice?
I think it was FSA. I think it was a field service. So.
It was in 2023, recently, where the IRS had asked the national office, can we do this? And the national office said, yes, you can net employee retention credit of a different taxpayer against the liability of a PEO, which we found, again, illogical because it seems unfair, but logical at the same time because the IRS doesn't want to go collect.
It's just logical because ultimately the IRS is issuing the refund under the PEO's EIN. The IRS has information that PEO has a tax liability. So they're just going to automatically offset any tax refunds under that EIN to satisfy any tax liability under that EIN, right? So, I mean, that's just basically how the tax law works, right, Tony?
Yeah, unfortunately, that's how the tax law works. But also in our search, we found that a number of organizations that hired PEOs and had this happen, they've contacted their House and Senate representatives and asked for help. And their House members sent letters to the IRS. And I think the IRS response was, that's just the situation, unfortunately. So this is an issue that if you are a company that's hired a PEO, you must be aware of this. And I think, again, there are only two options. One, make sure that you modify the agreement with the PEO to cover situations like this. And secondly, work with a certified PEO, although there's a significant premium for that. Those are the two means that we found are the protective means to avoid this unfortunate tax situation.